Namaste friends. So today's video is on the suggested answers for your May 26 AFM exam as well the future strategy. In fact, mostly I'll talk on the strategy for your future exams first, and then I come to the suggested answers. Most of us are aware that the paper was extremely challenging, and many students, I think vast majority of the students were finding the paper to be on the tougher side. We saw a lot of unseen questions, a lot of concepts were not directly available in the study material, so it was very challenging for students, and I somehow believe that whatever you guys felt during that exam is right. The video first will focus on what can we do for the next set of exams. I'm not even talking on the suggested answers now. Suggested I'll discuss in some time. I'll not spend much time on the suggested answers. Major time let us spend on what should be the strategy for future exams. How do I tackle my future exam? Now, most of you guys have been asking me what should we do for next set of exams, and there are students who are extremely worried. People who have written the exam, okay, but people who haven't written the exam and who are preparing for your November exam or maybe the next year exam, these guys are under lot of stress, lot of pressure is there. Now, few things I want to make it very clear to you, because unfortunately we faculties have a small role in the pressure which you guys are facing at this point of time, because you see lots of videos and every video tells you something, and unfortunately you get carried away, because I have been observing what is happening after the exams have got over. And first point is what to do if paper is tough like the one we did. Paper is tough like the one you have faced. What should we do for the next set of attempts? Now, the paper can be tougher. People are now asking, should we solve difficult questions? This is a doubt many students are having. Should I solve AI drafted questions? Should I do something else? There are teachers who are coming out with difficult modules, difficult questions. You can do everything you wish to, but I can tell you with my experience, you solve 100 difficult question, ICI will ask 101st difficult question, and unless concepts are very clear, that 101st question also you're going to struggle. So what should you do is not increase the number of questions now. Go to the depth of everything which is there in ICI study material. Depth means in-depth preparation of every concept, in-depth preparation of every concept which is there in the ICI material. Rather than enhancing the number of questions, focus on ICI study material and go to depth of everything. At a depth level you will have to understand, rather than trying to practice many questions. So my sincere request to students is, whether you are my student or any other student, don't chase any difficult questions now. Chasing that will not help, because when I used to teach maybe 900 questions in my classes, then I've cut it down also. When we used to do 900 questions also, and any new question used to come in exam, students were struggling that time also, they were struggling that time also. So if we do more questions, what you are indirectly doing is you're practicing a lot of questions, but you're not getting into the depth of every question. So when I say depth, I'll explain you a lot of concepts, what happened in exam, every question I'll tell you what, if at all we had gone in detail into something and maybe then managed it in exam, it would have been easier to handle. But we have a simple learning, some learning is there, and that extra clarity is not there, because of which small change in questioning pattern, and most of us are struggling. somewhere we as faculties have also prepared you or made students to go in that order, in that track. You are not coming out of the track because ICI has suddenly given a tougher, extremely tougher paper. I will not say anything else. It was the toughest paper in the ICI history. Okay, if paper is tough, should you do difficult questions to prepare for it? My answer is no. Should you do AI drafted questions? Again, my answer is no. Then what should you do? Read a concept, maybe put that concept onto the AI if at all you want to, and try to learn more about that concept. Ask the AI, can you tell me more about this point? What are the key conclusions, key points? Ask your doubts, get your doubts clarified. Because ICI has asked questions from even small points in the study material, and this is what I saw in IBS paper also. But IBS at least is open book. This is not open book, so we struggled. Paper becomes tougher. No need to prepare for any extra question, because even if you prepare for extra question, you will still not be able to manage the paper, or you have not been able to manage the paper. Good conceptual clarity there, maybe you will be able to manage. Second point, no selective preparation. The selective preparation story is not going to work out. You ask for ABC analysis, you ask for important questions. I have given my priority material questions. The priority material questions, obviously the main question itself has not come in exam. Where is the question going to come from? Priority material. But selective preparation is not going to work about now. Just doing selective preparation will not work. Yes, you can mark your set of questions you want to revise, but no selective preparation. You will have to do all concepts in depth, even areas which are not tested for a very long period, like Black-Scholes model got tested. Sharpe's model optimal portfolio got tested the second consecutive time. Last time itself, students were very unhappy with that model. And suddenly the second consecutive time they have tested, and students struggled even the second consecutive time with that. So no selective preparation. Third point is theory is game changer. Theory is going to be game changer for most of you guys. It is a game changer if you are prepared well, even in the latest attempt. Theory could have become a game changer. Theory doesn't mean those 5 chapters only. We do tell those 5 chapters. We have seen what has been happening in the past. This attempt also, from that 5 chapters, 16 out of 24 marks theory came. But still, that alone is not sufficient. If I read everything, maybe I could have handled more questions. I could have handled some of the other questions which are there. So theory is a game changer. Again, no selective preparation in theory. Theory also, you can't do any selective preparation. So this is the biggest problem we are facing at this point of time. Paper can be tough. Doing more questions is not important. Doing all concepts is important. Doing more questions is not important. Doing all questions is important. Doing selective theory preparation is not important. Doing all theory preparation is important. All means all. We see, I normally tell people that you prepare for everything, but still exam pressure, this stress, that stress, and you are not able to do, you go for selective preparation. That strategy is not going to work out. Looking at the two papers which I've seen, last time paper was still manageable. This time paper had more challenges than that. So tougher paper can be tackled if you do all concepts in depth. If you have done all concepts in depth, today I will show you what 50 marks of the paper you could have handled well. 50 marks you could have handled well. 50 marks difficult to handle. 50 to 60 could have been handled also, but difficulty is there. There are no doubts in all that. And there's a possibility that ICI may give some grace marks and other things. That possibility does exist. But anyway, some students are going to clear even in this tougher paper. But invariably, every student struggled. Most of the faculty's material did not cover these type of questions. Concepts are covered. Concepts are covered even in my book. But still, difficulties was of such a high level that because of the exam stress, outside the exam, easy for me to think and tell. But during the exam pressure, it is very difficult. Lengthy paper, extremely tough. All that is there. So my three main points: don't try to go for more questions, AI drafted questions. Complete whatever is given to you in depth. Don't do any selective preparation. and theory prepare all 15 chapters. Theory prepare all 15 chapters. Maybe next attempt turns out to be an easier one, turns out to be a tougher one, we don't know. Because why I'm not saying you to go for difficult or AI drafted is you don't have one subject. See, if you have only one subject, you do everything possible. I teach only one subject. I can do anything in AFM because I learn only. You today ask me to solve a basic direct tax question. I don't know. Basic direct tax question. I don't know how many Ind AS are there, how many law sections are there, what are the laws which are there, GST, how it works. I don't know. I'm not in touch with all of them. I can afford to learn AFM in depth because I do only one paper. I can solve even more AI drafted questions, more difficult questions, everything I can do. Look at your end. Look at your end. It is not possible, guys. It is not possible. Don't fall in the trap of this because people will say, do this, do this, do this, do this, do this. Don't try to get classes just because you want to do difficult questions. Get classes if you want to have conceptual depth. Then try to get. Even my students struggled. I am not saying that my students enjoyed this paper. They were also struggling. Everyone struggled. There are no doubts on that. Now I come to the uh, every paper I have given a reference, and this was the broader overview. We used to do a block methodology. My block methodology also not greatly worked here. Block 1, which is what is predominantly tested, was tested only for 30 marks. Block 1 was tested only for 30 marks. Forex derivatives portfolio, which is a deadly combination, tested for 41 marks. Theory was tested for 24 marks. 24 marks theory got tested, and then your allied areas. So theory, if you have not prepared well, you could have struggled with the paper because theory, generally we don't pay that much attention to theory, and if you don't pay that much attention to theory, you would have struggled automatically in the paper. Now let's go to one by one. First question, I will tell this question to be on the easier side. It is an unseen question. It is on the easier side. Government of India issues a 5-year sovereign gold bond. Issue price is 5,000 per gram. Investor purchase 200 grams. So as you read, you understand 200 grams he purchased. So 200 into 5,000, 10 lakh is the cost. 200 into 5,000, 10 lakh is the cost. Bond carries a coupon rate of 2.5% as simple interest on the initial investment. On the initial investment means 10 lakh into 2.5%, 25,000. At the end of 5 years, bond will be redeemed at the prevailing market price of gold. Prevailing market price of gold. Interest is taxable at the investor's slab rate. Whatever is the slab rate of the investor, the taxation will come. Any capital gain arising on redemption is taxable at 20% after considering the benefit of indexation. Benefit of indexation means you'll have to index the cost of acquisition. You used to be given some CIE cost inflation index, but here they've done something else. Inflation is the indexation rate. Inflation is 4% per annum. Inflation is 4% per annum. Investor purchases 200, 30% tax bracket. What is the interest income after tax? After tax is 25,000 minus 30%, 17,500. First option is eliminated. It could be either of the three. Then approximate real post tax return. Real post tax return. What is real post tax return? I get a return of 2.5, post tax 1.75. This is called nominal return. For real return, approximate they've asked. Approximate means, I used to tell in the class also, approximate means you can do, that is what in the MCQ it will work. Approximate, what you can do, nominal rate is equal to real rate plus inflation, where we learn in capital budgeting, real rate plus inflation. So nominal rate is 1.75, real rate I'm calculating, inflation is 4%, goes to the other side, minus 2.25%, minus 2.25%. This is a basic question, could be handled easily. After 5 years, gold price becomes 6,800 per gram. Inflation is constant at 4% annually. Inflation is constant at 4%. What is the indexed cost? Indexed cost means 10 lakh plus 4% 5 times. You have to do 4% 5 times in the calculator. 10 lakh plus 10 lakh plus 4% for the first year indexation, second year indexation, third year indexation, fourth year indexation, fifth year indexation. You will have to index it. I'm getting 12, 16, 653. First one is eliminated, second one is eliminated. Two choices are still there. 12, 16, 653. At what rate am I selling? I'm selling at 6,800. So 200 into 6,800 is 13 lakh 60,000. This minus 1216 is the capital gain. And they are saying if you redeem and you are in 30% tax bracket, what is the net amount received after capital gain? Capital gain is 20%. Capital gain is 20%. So 1360 minus 20% of 143,347. 143 is the capital gain. 143,347, 20%. 20%, 1360. 13 lakh 13,331. This ideally you should get full marks is my view. Okay, this is a manageable question. Clear? First question is over. Coming to the second question, this is not an unseen question, but I have been telling students that this is not a fully logical question, but it is not an unseen question. Why it is not an unseen question? I'll show you the question. Institute study material 9.46. I'm not going to give reference to my material. Okay, I want to give reference to institute study material only, so that you see in institute study material. Obviously, if it's there in institute study material, it will be there in my material also. This is the question. Suppose MIS Limited is considering installation of solar electricity generating plant. Plant shall cost 2.5 crore, saving in electricity expense 21 lakh per year forever, 12 lakh or 35 lakh. Assume WACC risk-free rate. Should you accept the project or not? This is the question. Okay. Here, our cost is 3.2 CR. You can have a saving of 25 lakh per year in perpetuity. In my material, I used to give two answers: logical answer, ICI answer, and I used to tell students to follow the ICI answer. But yeah, this is a challenge because in case you try to think on the logical way, 3.2 crore, 25 lakh per year in perpetuity. There is an uncertainty. If you do high saving 15 lakh, low saving 15 lakh, high saving 40 lakh. If you want to invest 3.2 crore today and 25 lakh in perpetuity, WACC 9.5%. What is the NPV if you invest today and NPV later? First thing is 3.2 CR is my outflow. Inflow is 0.25 divided by 9.5%. 0.25 divided by 9.5%. 3.2 I subtract. I get negative 0.57. With this, remove the two choices. Remove the two choices. Negative 0.57. Negative 0.57. Negative 0.57. Second one, if it increases to 40 lakh, our NPV is 3.2 plus 0.40 divided by 9.5%. 0.40 divided by 9.5%. 3.2 I do. I get 1.01. 1.01. 40. 9.5%. 3.2. Yeah, 1.01. Story over. I just put a tick here and story over with the first one. Then they are saying 3.2 crore. 40 lakh or 15 lakh. Risk-free rate is 6.5. Using risk-neutral probability. Compute returns in both the scenario. Returns means what am I getting as returns? What is return? I invested, that is, let's take this number 1.01 on 3.2. I have not even done the other scenario. 1.01 divided by 3.2, 31.56%. These two choices are eliminated. 31.56%. The other two choices, this is smart work. Okay, I've eliminated the other two choices. I'm not doing the low one. Low one has to be negative 50 only. We're not doing the low calculation. And probability, they have given it in the next one. They have given the probability in the next one. They have given the probability in the next one. So smart work, if you do, you can put a tick here. Next one, they have given the probability also. With the smart work, I put a tick on 69.5% and proceeded. We just put a tick on 69.5%. How probability is calculated? If you want, the calculation is here. This return P1 minus P and you get the probability. After this is done, then they are saying, if you wait for a year, then savings will be 40 lakh, 15 lakh, WACC 9.5. A minute, guys. Okay, sorry. So this one on 3.2 CR, the savings will be this. We have already decided the NPV for these two scenarios. 1.01 crore. I'm not even doing a lot of calculation. Other one is 1.62 CR. Probability for this was 69.5%. Other one has to be 30.5%. There is a problem with this because whenever it is an option, I used to tell in the class that 30.5, the value should be 0. You can't have a negative value. You can't have a negative value because if I wait for a year, I can decide whether to invest or not. 40 lakh means I'll invest. 15 lakh means I'll not invest. So it should be 0. This is the problem I had with institute question. So 1.01 into 69.5%, 70 lakh. This one 1.62, 30.5%, 49.41. Net amount is 70.19. You get 20.79 and divide this by 20.79. I'll have to divide this with the WACC and risk rate. So all these options are automatically eliminated. Answer is this. Divide by the risk-free rate, that is 1 plus the risk rate, 1 year discounting. 1 year discounting. This is a manageable question if you have done the ICI study material properly. So 12 marks, first 12 marks are manageable. Okay, this is difficult 100% if you have not prepared the theory, if you have not prepared the theory from the ICI study material or from my material of this chapter, chapter 14, that is page 14.12. 14.12. This is the meaning. What is poison pill? You need to know. What is green mail? You need to. Green mail refers to an incentive offered by to the potential bidder. Management may offer the acquirer a higher price for its shares than the market price. Higher price for its shares than the market price. This is green mail question. This is green mail question. Substantial amount of convertible debentures. Substantial amount of convertible debentures. The target company may issue substantial amount of convertible debentures to be converted on the future date when it faces a potential takeover threat. Poison pill. Unfortunately, nook and corner you need to know. That is the difficult part. I agree. Then you see the next one, which is your uh, the equity carve out is the answer for the next one, which is here. They're saying R Limited is a parent company. In order to grow at a faster pace, it carries higher valuation. To unlock and generate cash, a strategic avenue is to go through an IPO. A parent firm makes a subsidiary public through an IPO of share amounts to a partial sale of a new publicly listed company is created, but the parent keeps a controlling stake in the newly traded subsidiary. So these are called equity carve-outs. Equity carve-outs. So this you will be able to answer only if even my material I would have shortened the points. So my material does cover it, but I've shortened the points. This I may feel it is challenging for the student to do if they have not read nook and corner of ICI study material, which is difficult. Which is difficult. So by now, some confidence should have come. Okay, 18 marks could have been managed if we had done the study material fully. I'm not talking about my material at all, study material. Okay. Next question. This again is a challenging, very challenging question, but not fully away from the institute study material. Not fully away from the institute study material. I'll go to the page numbers. I will go to the institute study material page numbers. I'm not even going to my material because when I go to my material, it will feel that I have covered I'm talking about something which is there in my material, not there in ICA study material. Consider a portfolio consisting of 2 crore investment in XYZ, 2 crore investment in ABC, daily standard deviation 1%, correlation coefficient, 10-day 99% value at risk. 10-day 2 crore in XYZ, 2 crore in ABC. What institute? I want to invest 25 lakh in alpha and beta in the ratio of 60-40. So alpha 15, beta 10, weight is 60-40. Daily standard deviation is given, correlation is given. Mr. X wanted to measure VAR for confidence level 99% and 90%, 99% and 90%. Z score 99% confidence level, 90% confidence level, 99 and 90 you want to do. They are asking what is the value at risk, annual value at risk. Annual value at risk means first I need to know the portfolio standard deviation, which is you will have to do sigma alpha w alpha square, sigma beta w beta square. It is done here. Weight of alpha, standard deviation of alpha square, weight of beta, standard deviation of beta square, 2 weight of alpha, weight of beta, standard deviation of alpha, standard deviation of alpha, correlation of alpha beta. Once you do all of this, you get 95904%. Standard deviation, you take it and then you follow the formula. Is it new here? No. You see the solution. Have calculated variance of the portfolio. After the variance of the portfolio is calculated, calculate the standard deviation 0.80623%, then the standard deviation in amount, and for 10 days square root of 10, we are doing square root of 252. Square root of 252. Now this question should be manageable. Second, 100% difficult. I am not even going to this is difficult, not covered in my material. I have maybe in one batch I have discussed that something like this can come, but not there in my material. So let's not call that is there in the material. What is the diversification benefit? What is diversification benefit? Is the reduction in the standard deviation due to diversification. What is reduction? Somebody did 15 lakh investment standalone. Somebody did 10 lakh investment standalone. You will calculate the VAR for 15 separately, 10 separately, add them and compare that with the VAR of 905. So standalone VAR 15 lakh, 10 lakh, daily standard deviation, 90% multiple, and you get 2340, 11520, 2340 and 11520. Together you are getting 31338. This is at 90-day confidence level, and diversification benefit is 3252. The difference between the two, sum of individual VAR minus the portfolio value at risk, minus the portfolio value at risk. Then comes the last question where it increases. This also I would not say is difficult. Okay, your correlation increases. Correlation increases from 0.60 to 0.80, 0.60 to 0.80. If this correlation increases, substitute 0.8 here, automatically variance will go up, standard deviation will go up, value at risk will go up. Value at risk will go up 1.03. Value at risk increases to 953, increases 48,407, rounded off to 48,085. Clear? This two questions manageable, one question is very difficult. Okay, so till now I feel 8 MCQ questions are manageable, 4 are difficult. The theory is also difficult. Case scenario 5 is also challenging, very challenging. I felt this to be an extremely challenging question. Concept is there in the institute study material, but it is a challenging question. It is a challenging question. I'll quickly discuss the answer. They are saying Green Agro Limited enters into a 3-month forward contract on January 1. This is the entry date. Execution will happen on April 1. I entered on Jan 1. On March 1, what is the maturity settlement? Maturity settlement means if you wait and settle it, we have entered into a forward contract. Green entered into a 3-month forward contract on January 1, 2026 to buy USD 2 lakh import payment. I have to buy. So buying will happen at, the name is Exports Limited, but they are buying. So 2 lakh into 84. This is eliminated. Only one choice is eliminated. Now, instead of paying 84, I do some smart thing. Smart or stupidity. I cancel the contract and rebook a new contract on this date. If you have done a contract at 84, cancellation will happen at a 1 month forward rate. 1 month, we have entry date, execution date format, but I'm quickly discussing. So I will cancel at 83.7. I'll cancel at 83.7. Cancel at 83 point, just give me, 84 was the original contract. Yeah, we cancel it at 83.7, and then we go ahead and do a rebook a 1 month forward contract, rebook a 1 month forward contract. The 1 month forward contract is at, there's something, there is some, just a minute guys. Okay, I think my answer is wrong here. So that's why I got a little confused. So I cancel this contract, and if I take a new contract, it will be at 84.1. I don't know. In my answer, I've said a new contract is at 84.05. Not sure what I've ended up doing that. So this new contract is at 84.1, because we are taking a 1 month forward contract. 1 month forward contract is 84.1. I don't know. I saw this by mistake. Something has happened. 84.1. If we are taking this, if we are taking this contract, indirectly what will happen is my extra cost is 60,000. This if I add 84.1, if I consider 84.1, it will become 84.1 into 2 lakh, 1 crore 68 lakh 80,000. I don't see an option of extra 80,000. So maybe ICA takes extra 60,000, takes extra 60,000. Something seems to, or I have done some typing mistake. I don't know. I don't have the entire question. I have typed it. So something could be wrong here. Next, import obligation is settled early on March 1. If you settle early on March 1, first you will cancel. Cancel will happen at 83.7, and settlement will happen at 83.75. Settlement will happen at 83.75. Spot ask rate. Settlement will happen at 83.75. In that scenario, overall payment cancel at 83.7, new at 83.75. It will become 168.10. 168.10. MTM loss, again too many things they've asked. So they have asked for MTM loss on different dates. They're asking on the MTM loss on Feb 1. Feb 1 is on Feb 1. If you cancel the contract on Feb 1, if we cancel the contract, what is going to be the loss? I think some error has happened in the table. The rates, just give me a minute. I'll see the rates, and maybe because of which only that some issue there in the copying the rates. I've done some error, I think. Let me see the rates now. Yeah, it was 84.05 only. So the answer is right, guys. This, I think my typing errors are there in the question. It is 84.05 only. Then whatever answer is there, that is right. Okay, whatever answer, because I just got a little confused when I was reading this. 84.05. This also, I think, goes to the next two columns. So some typing errors are there in the question. You can look at your institute study material question. Answer is right. Answer is right. Then no. What we are calculating is what is the loss on each of the dates. What is the loss on each of the dates? How do I calculate the loss? I will show it with the institute exam paper itself. 84 contract entered, cancelled. If you cancel in February, you will cancel at the bid rate. 84, 83.95. You will have a loss of 10,000. Moment there is a loss of 10,000, this option is eliminated, this option is eliminated. Two options got eliminated because of this. February there is a loss. February there is a loss. March, let us complete it. April, let's not do it. Why should I do April? Because March I'm done. I'll get to the answer. March cancellation with this 1 month forward rate, March cancellation 60,000 loss. So smartly, if you do, you need not do the April calculation. March cancellation, and the answer is done. my printed answers are right. There is some rate I have done some error. Okay, so don't worry about it. This question I feel is on the trickier side. Students would have struggled with the question. Concept clarity is there. Maybe you could have handled a little bit, but it is a difficult. So there are no doubts on that. So out of the 30 marks MCQ, maybe around first three questions, I feel you should score marks. Next three, you should score marks if you have done that question from the institute study material. Scenario 3 is very difficult if you have not done the theory part. Case scenario 4, two questions are manageable, 8. And some of this may become manageable. Some of this, not everything, okay? Some of this may become manageable. Major chunk of it may not be manageable. Major chunk of it may not be manageable. Some typing errors are happened in the options and all. That's okay. Let's not worry about it. So this is as far as MCQ. You could handle around 8 questions properly. 7, your luck factor may play out, and maybe you score 10 out of 15 if decent level of institute study material preparation is there or any good concept book is prepared. Okay. Now comes the descriptive question. First question, newly drafted, covers currency swap, international capital budgeting, different thing they have asked, and because of which it could be a very challenging question for students. I'll read it. Initial capital required for the project is 4,000 million valors. Valors is some currency. Under the agreement, BIL will sell the project back to the government after 4 years for a guaranteed sale price of 8,000. During 4-year operational period, will provide something, and there is a currency swap. I'll show you that currency swap adjustment from the institute study material. From the institute study material, I want to show you everything. Institute study material, if I go to 10.74, 10.74 page, 10.74 page, this is the question. The project will require an initial investment of 500 crore. The oil field along with the equipment will be sold to Indian government for 740 crores. Since the Indian government will pay for the amount in Indian rupee, company is worried. Assume the Indian government offers a swap at a spot rate which is $1 equal to 50 in 1 year. Then should the company should opt for this conversion or should it do just nothing? Okay, this was the question from the institute study material. Now here, I want to invest 4,000 million dollars. I'll be selling to the government, same government only, 8,000 million dollars. There'll be some technical assistance. I get 80 million to hedge the currency risk. BIL will swap the principal to Indian rupees at today's spot rate. It will be reversed, re-exchanging at the same rate, reverse on the last day. Bank will charge some facilitation fee. This is calculated on the rupee amount. On the rupee amount, so it will be directly in the rupee. Currency swap covers only the initial amount and terminal principal. Hedge all using the forward rate. Now, rates have been given. My initial outflow is 4,000 divided by 50. 4,000 divided by 50. 50 is the exchange rate on day 0. Divided by 50. Okay. Every year, I'll be getting 80 million. This 80 million, I'll convert at the rate of 53, 56, 59, 63. 80 million, I'll convert at the rate of 53, 56, 59, and 63. This is my inflow. I'll be getting 80 million. I have to pay 0.3%, 0.3% of 80 million, 0.3% of 80 million, 0.3% of in Indian rupee, whatever is the amount. So this is my maintenance income, this is my facilitation fee, and this is my net income. On the last day, we get back 8,000. We get back 8,000. In that 4,000 will be at 50 only, that is re-exchange, and balance will be at whatever is the forward rate. Have we done this type of question in that currency swap question? Yes, that currency swap question has this adjustment of the last day, but there are a lot of other things also. NPV positive, go ahead with the project. NPV positive, go ahead with the project. Go ahead with the project. This is question number 1A. Difficult, very challenging, very challenging. Let's not get into much about it now. Question 1B came from H model. Now, is it there in institute study material? Answer is yes. Do students prepare for this? Answer is no. Did my students prepare for this? Answer is yes. Did my students answer this in exam? Answer is no. So it is because though it is covered in our material, many of my students could not handle it in exam pressure situation because this has never been tested. So the mindset is, why should I prepare for this? There is a similar question in my material. Institute study material has the concept, not question. Concept is there, question is not there. Question is not there. I also have a question, but still I know my students have not been able to manage this properly. They have not been able to manage this question properly. I'll show you the institute study material. Again, my job is just to show you institute study material and make institute study material now more like a Bhagavad Gita for you or your AFM. Don't focus only on the faculty material. We are doing a good job, but institute is institute. This is the formula for H model. D0 into 1 plus Gn R minus Gn D0 H1 Gc minus Gn R minus Gn R minus Gn. This is the formula given in the institute study material. None of the books have tested, sorry, none of the institute study material questions have come in the past on this. Is it covered in our material? This is the only question where I want to show my material. I've not been showing my material till now because I felt everything is covered in the institute study material. This is just fortunate. Okay, fortunately I've covered one example on this. It's just fortunate. Maybe sometimes it's possible that I don't even cover a concept itself. It is possible that faculties, in order to simplify things, we sometimes miss out on this. This is an example, and with this example, you get an answer. Coming to the question which is there, more or less, this was there in the question also. For example, D0 I want in that formula. D0 is 40. It recently paid a dividend of 40. So I take 40 into 1 plus gn. Gn is normal growth rate. Normal growth rate. Gn is normal growth rate. So if you see here, they have set 1 plus gn, 15% growth rate will decline. Transition period, current data, terminal data. Terminal data is terminal growth rate. ROE into retention. 12 into 50, 6%. 6% is the normal growth rate. As of now, the growth rate is 15%. It will become 6%. It will become 6%. So I apply this here. 1 plus 0.06. K may be given in the question. K is the cost of equity which we are using. Year transition period, ROE, terminal data, required return. Required return is 13%. I follow 13% here. Minus 6% plus the same D0. We take half of transition period into the higher growth minus the normal growth divided by 13 minus 6. Now, if at all you have done H model institute study material, you could have managed this. Difficult. I am now going to say easy and all. 734. How much is the deviation? This question I feel is a manageable question. The previous one is very difficult. This one is a manageable problem. Okay. Question 1C. Concept is on sustainable growth rate, but could be challenging for students unless you have clarity on what is exactly sustainable growth rate. So I show from institute study material first what is sustainable growth rate, covered in my material, covered in most of the teachers material. What is sustainable growth rate? Let us see that wording first. Once we read the wording of the ICAI, we will be in a position to handle the question. This paper, if it was an open book exam, I would have been very happy because then I can open institute study material. Sustainable growth rate, concept by Robert C. Higgins, can be achieved given the firm's profitability, asset utilization, desired payment ratio. Sustainable growth rate is a measure of how much money, how much a firm can grow without borrowing more money. Now they are saying our sustainable growth rate is 10%. I can grow 10% without borrowing more money. But I want to grow at 16%. If you grow at 16%, you need more money. If you need more money, you'll have to borrow. But borrowing is not possible because debt to equity ratio is already at the maximum limit. So I can't borrow money. If you want to borrow money, then you can achieve 16%. But borrowing is not allowed because we are at the maximum permissible limit. We are at the maximum. The company is already at its maximum permissible limit. I can't take any extra loan. Sustainable growth rate without any fresh equity, without any fresh debt. If you take fresh equity, fresh debt can also come. Inflationary pressure. As inflation increases, your value of assets will increase, and you will have more requirements for, because value of assets increases, balance sheet value increases, you need to raise money. What are the alternative courses of action? For that, first I gave what is the formula of sustainable growth rate, because this is critical. With this, you can either go for extra equity infusion, is improving equity multiplier, or improvement in profit margin, or the retention ratio, or the asset turnover. Any of them you improve, you will be in a position to manage this. Any of them you improve, you will be in a position to manage the story. This is question 1C. Theory question. Again, depth clarity is needed, not more reading. Depth of clarity is needed as to what is sustainable growth rate. Question 2A. This is there exactly in institute study material. I'll keep going back to study material. There in my book also. I'll go back to institute study material. Chapter 6. Chapter 6. Question number 15. See, why I am giving references of the institute study material is to tell you how ICAI has prepared the paper. Nowhere I am trying to say the paper is on the easier side. So please, your students then will say, no, everything was from institute study material. Not everything. There are a lot of things which were at different things. But yes, good part, if this is the data, one sensitivity, factor 2 sensitivity, zero point 0.8, 0 0.6, 1.5, 1.2. What is the sensitivity of the two factors? All this is given. Same thing. Two securities according to this beta of factor 1, factor 2, expected return, risk free. Whether they are correctly priced or not, how will you calculate? Return under APTs RF plus factor 1 beta into RP of factor 1, factor 2 beta into RP of factor 2. So you take 6 plus 1.2 into 4 plus 0.5 into 5, 1.2 into 4 and 0.5 into 5, you do the calculation 13.3, 16.2, 14, 16. We are required return is lesser, actual is more. That is a good security buy, undervalued, other one is overvalued. Then they are saying, I want to create a portfolio. I want to create a portfolio where I'm going to take a long position and short position. What institute done in study material? It said I'm going to invest 1 lakh and sell short 50,000. Answer is 1 lakh and 50,000 only. The same question only. They ask what is the sensitivity. Here they have given a target sensitivity. I write my target sensitivity here. Weight, factor 1, product, factor 2, product, target sensitivity is there. Form two equation, solve them. You get the weights as 150 and negative 50. 150 and negative 50. I feel this question can be managed by students. This question can be managed by students. Question 2B, not there in institute study material. Concept itself is not there. They have not used the term ATM, ITM, OTM and all in the institute study material. Easy to know, but still not covered means not covered. I can't say that this is covered in the institute study material. Now here they are asking for Alps company shares traded 2000. They have given type, strike premium, contract size, assess whether it's ITM, ATM, OTM, intrinsic value and time value component. Again, one more question. I have to go back to my material, because then only you'll be able to appreciate some of my discussion. This is not a very tough question, but students who have not understood what is ITM, ATM, OTM, because institute study material doesn't cover it. That is one challenge. Second challenge, you see this question. State whether each of the following is in the money, at the money or out of the money. This is what is tested. And consider the data, calculate the intrinsic value and time value. Calculate the intrinsic value and time value. Exactly same thing they've asked in the exam. The same thing they've ended up asking, intrinsic value and time value, and in the money, at the money, out the money calculation. Going back to the question, the requirements are whether it's in the money, at the money, out the money. All option will get exercised if the actual price is higher than the current market. So if the actual price is higher than the strike price, so this is in the money. Both are equal at the money. This is out the money. Put, this is out the money, at the money, in the money. Intrinsic value will be 0 for at the money and out the money. Others intrinsic value is difference 80, 80. Time value is the gap 130 minus 80, 50, 85, 45, 40, 95, 75. This is one. Then they're saying price may increase by 150 or decrease by 150 for everything. They're saying whether it will be exercised or not. How many calculation they want for 4 marks? That's my problem with this question. So then increases to 2150, whether it will be exercised or not, you answer. Gross payoff you calculate, net profit you calculate, and profit or loss. Then price decreases, again same calculation. uh, not a very easy question for 4 marks. Concept is not there in institute study material. It is not there in the institute study material. Okay, let's move ahead. Okay, this is a theory question. I feel this is a very scoring question. Okay, in early stage startup, valuation is on DCF. How will you do DCF method? Startups don't make any profits. When profits are not there, DCF method can't work. So no, can't be used. Use staged funding. Yes, there is stage funding. First stage, second stage, seed stage, pre-seeds. A lot of stages are there. Yes, this is right. Bootstrapping reduces dilution. Dilution means I don't dilute my equity. True bootstrapping means managing with my own funds. But it will limit growth. It will limit growth. Angel investors generally invest at a later stage. No, they invest at an earlier stage. They invest at the earlier stage, seed stage, seed stage. So this is a scoring 4-mark theory question. Question 3A. My God, this question, when I discuss the answer, you will feel, well, is it that easy? But in exam, not possible for you to manage. Very, very difficult. Very, very difficult to manage in exam. That is why I said depth of concepts rather than more questions. Depth of concepts rather than more questions. Understand this now. I'm going to do a 2-year project. Not covered in my material, not covered anywhere. So that's okay. Initial investment 40 lakh. After tax, life, unlevered, spot rate, corporate tax rate. Borrowing currency, these are my interest rate. Okay, and the risk free rate, somewhere we'll have to see. Interest rate in USA 3%, interest rate in Europe 5% per annum. I assume in India is 9%. So these I'm assuming it to be the risk free rate. I'm assuming it to be the risk free rate because IRP wants that risk free rate. So whether you borrow at 3% in US, which is the risk free rate, 5% in Europe, which is again the risk-free rate, 9% India, which is also the risk-free rate, all three are same. All the three are same because all are risk-free rate. Understanding is all are risk-free rate because I don't have any other option. 3 and 5, 3 and 5. Even if you do IRPT and calculate, because some students will try to do IRPT, calculate future rate and then do, in the end, everything will be same outflow. Everything will be same outflow. Which is the cheapest? All three are cheapest. All three are cheapest and all three are equal. Which one will I still do? I want money in euros. Please go for euro borrowing. There's another indication also. APV approach wants you to discount the tax benefit at a pre-tax cost of debt. The pre-tax cost is 5% here. That 5% matches the Europe one. That 5% matches the Europe one. So smartness you manage with that also. 5% is for Europe one. The table tells you that some hidden story. APV, what you do? Outflow 40 lakh, inflow 25 lakh, discount it at 12%, get the answer in euro. Ultimately, I'll convert into INR, get the answer in euro, 40 lakh and 25 lakh. That is called base case NPV. Tax benefit is APV approach says whatever loan we are taking, 40 lakh into 50% into the interest I pay, into the interest I pay on that interest, I assume India's tax rate, tax benefit, and discount that tax benefit at pre-tax cost of debt. All these are in euros, convert them into INR in the end. Convert them into INR. First one, if you had an understanding of how IRPT works, may be managed, otherwise very challenging. Let's not debate on this question. It is a very challenging question. Paper had a lot of challenging questions, so that's the problem. The problem is there were many challenging questions. 50 marks I can still feel manageable. Okay, in MCQ around 20 marks can be managed. In descriptive, now this 4 mark can be managed, critical one, not this, and this 6 mark can be managed. Marks is in In the first question, H model could have been managed if you had known an H model. Otherwise, that first entire question is out. Entire first question is out. 10 marks manageable here in the second question. Okay, this one is difficult. This one is available in Institute Study Material, but 4 marks again. Problem is 4 marks. I'll show you the question. TYK question number 2 and question number 10 of the of the Institute Study Material. So question number 10 of the my material and Institute Study Material. It is covered in question number 17 and uh, question number 17 and question number 2. I'll show you the question. Let's go to the mutual funds question. Mutual funds question. Mutual funds question. One is your entry load and exit load, which is tested concept in this question. And the second part they tested is uh, this one. Question number, yeah, dividend plan and bonus plan where we are investing 2 lakh everything. Lot of investments happen. Only one investment in our exam question. Only one came. I'm investing 12 lakh, 720 in the first one, 480 in the second one. NAV is 48. On the NAV, you'll have to pay the entry load. So divide by 48.96. Entry load is 2%. Then you get your opening units. Then dividend plan, units, dividend, reinvestment, new units, total units. These units you sell at the closing NAV, pay exit load, pay the cost of acquisition, return is 19.9%. This is manageable question. 4 marks is a disaster. This should have been a 6 mark question. Then bonus plan, 9803. You get the units. Bonus plan gives higher return. Bonus plan gives higher return. This could have been managed, or maybe this entire question you could leave it in choice also. The entire question could be left in choice, provided you were able to tackle other questions. Okay, well, a lot of questions are challenged. Question 3C, not a direct theory question, but you need to know what are the benefits of originator and problems of securitization. Again, this is covered in the Institute Study Material. I am telling you why this is, because I want to give you some comfort that yes, if I go with full depth, I may be able to handle paper to some extent. I am nowhere saying this paper can be still handled to a greater extent. You can't manage it, but some extent. Angle of originator, there are some benefits. Off balance sheet financing helps to improve financial ratio, reduced borrowing cost, and this is the same thing. Cleaning balance sheet, it cleans the balance sheet, improves the ratio, liquidity generation. These points are there, helps to improve financial ratio, reduced borrowing, off balance sheet financing. Regulatory challenges because it's NPA and valuation, because NPA means there will be certain complaints needed, provisioning could be there, transferring the asset to us could be difficult, and valuation is also difficult. Theory, the balance sheet cleaning part is easy, other part is little difficult. If you want, you could have left this in choice. Question 4A, cutoff point already tested, again tested in exam. So now if we say that this is difficult, I have a problem with us friends rather than ICAI in this question. Okay, because cutoff point is something which we have already seen, and good is they've given the cutoff point. Concept only says is calculate the train-or ratio. Calculate the train-or ratio. This, some of my students should have handled this little better. The return minus the risk-free rate divided by beta. Calculate this. Wherever you are above 7.95, accept, reject, reject. For this, you have to calculate proportion. Proportion means you need to know, remember the formula. I understand remembering the formula could be little difficult. For cutoff point, I try to simplify in my latest batch, but they have asked also weights. Weights, this is the formula. Beta by sigma squared Ci, train or minus the maximum cutoff point. Get this, and in this proportion, you'll have to put the weights in this proportion. Third one is easy. For CAPM, get the expect. So first one easy. What security? This one easy. Cutoff point also you don't do, it's okay. Expected return and valuation of each. Expected return is RF plus beta into RM minus RF for those two securities only. And it means the returns are on the higher side, undervalued, please buy it. Sharpe's index model compared with CAPM assumption, theoretical, difficult. But they are consistent here. Consistent means Sharpe model said these two security, and your CAPM is also saying both are good. So somewhere some theoretical points, but difficult. Okay. Uh, Two questions easy, two questions difficult. Maybe those two questions carry 3 marks in exam. Then came question 4B. Close-ended fund concept I've explained to my students. Close-ended fund means you cannot buy at the NAV. You'll have to pay NAV plus or minus premium. Find the average return based on geometric mean who bought 1000 shares of the closed-ended fund at the invitation, sold at the end. So you purchased for 20, sold for 22.3 plus 4%. In between, we don't get any dividend, anything. Okay. Geometric mean, unfortunately, this is CA inter-study material. CA inter-study material will calculate the geometric mean. Geometric mean is calculated like this, are basically time value of money. In between returns are of no use here. Okay. In between returns are of no use. Geometric mean calculation. If every year you calculate returns, then you can do geometric mean like this. Here in between returns are of no use. So directly what I can do is 20 present value is equal to future value divided by 1 plus r power n. That r is the geometric mean here. So 23.192 divided by 1 plus r power 4. R is the geometric mean. For NAV they want geometric mean, then do 20 with 22.3. 20 with 22.3. We are earning more. We are earning more. Reason is we got extra 4% on the closure. So we are earning 3.77. NAV is only 2.76. We are earning more because of that extra 4% which we got. Extra 4% for a 4-year period. Third question, yes, that is not a difficult one. Part of the important chapters should be able to manage. So in this question, this 4 marks you should manage. This I have my own set of doubts. Maybe you couldn't do it. Maybe 3 marks here. So 7 marks, 20 marks of MCQ. First question 10 marks. First question 10 marks. Second question, let's see how many marks is possible for us to manage in an exam stress scenario. Second question, the 10 marks is from 2B. 10 marks is from 2A to B. First question, nothing is possible. It's on the very difficult side. Then I proceed forward. This is done. Then we move to question 4C, an alternate question, very, very difficult. I got really surprised to see such a question. 100 crore floating loan, reset annually, collar strategy. In a collar strategy, where you buy a cap, sell a floor. Cap rate is 9.5. Identify that will make the collar a zero cost. Zero collar means present value of floor outflow is equal to present value of cap inflow. Present value because they have given discount factor. Cap will get exercised only at this stage. So cap is 100 CR into 1.1% into 0.84. This should match here. This should match here. This should match here. If you see the floor rate theoretically will come in between 8.6 and 9.2. That in exam stress is difficult for you to know. How will it come between 8.6 and 9.2? Because see, if it exceeds 9.2, all the three will have outflow. That will not match this number. All the three outflow together will not match that number. There will not be any outflow in this. It will be 0. These two alone will have outflow. These two alone will have outflow. We assume that as F. Do the calculation. We get 8.683. If you assume all the three have outflow and do the calculation, you will not get above 9.2. You will still get a number below 9.2, which is wrong then. Which becomes wrong. Question 5A. FCFE based valuation. It had a reverse working element question and as well the normal FCFE valuation. First part easy, second part very difficult. Let us see this now. Value 425, currently trades at 240. Two-stage FCF, net income is PAT. Net income will grow by 25%, so 180 plus 25% and again plus 25%. This is projected to be 240. Net investment in operating asset. Net investment in operating asset means fixed assets plus current assets minus current liability. This 240, they are saying something is mentioned. 30% will come from debt, 70% will come from equity. So 70% equity part alone you subtract it. 70%, this is called FCFE, cost of equity, discount this, Part 1 is possible. Present value for the high growth phase. Present value for the high growth phase is possible. Second one is little challenging. They have given 240. Reverse working. What is reverse working? The value of the company is 240 into 60, 14,400. In this 14,400, the high growth has given 118. The balance is going to come from infinity valuation. This is 14 to 81. Reverse work here you get 17,918.64, and this 17,918.64 is equal to FCFE2 into 1 plus G divided by KE minus G. This is perpetuity valuation reverse working. FCFE2 into 1 plus G divided by KE minus G. What is FCFE? The FCFE2 into 1 plus G is FCFE3 technically. It's FCFE3 because FCFE3 is different here. FCFE3 calculation is presented here. Last year PAT, add the growth rate. I don't know the growth rate. Less equity needed for net capex and working capital. They have said I need 20% of PAT is the investment. In that 20%, 70% from equity, and FCFE is this 241.875 plus 241.875 G, 241.875 plus 241.875 G. Once you do this, you'll get 10.5 and very difficult to handle in exam stress. First part could have been managed. Second part is difficult. Question 5B. Okay. Zenith Commercial Alco is evaluating the repricing risk for the 90 days bucket. Following quarterly data is available. Rate sensitive asset, rate sensitive liability, quarterly net interest income. Bank's earnings at risk limit is 8%. Hedging is mandatory. Identify the gap position, evaluate. Now, if at all a student had read this from the institute study material or even from my material, a gap or mismatch risk arises from holding asset and liability and off balance sheet item with different principal amount, maturity date or repricing date, thereby creating exposure to unexpected changes. Positive gap indicates banks have more sensitive asset than sensitive liability. They are asking what is the gap position, positive or negative. Liability is more, asset is less, negative. Then second, if interest rate go up, I will lose 5% on this. Very simple. On the liability, I'll have to pay extra 5%. This is thinking, but very difficult. 0.5%. This also 0.5%. This is my extra expense. Other one is extra income. Expense will be on the higher side. So this will ultimately have a loss for me. Loss of 16.5 CR. Extra income, extra expense. Repo rate goes down, lower income, lower expense. Lower income and lower expense, profit will go up. And this number as a percentage of net interest income should not exceed 8%. Should not exceed 8%. It is not exceeding. So we are not reaching that EAR limit. Some EAR limit, they've said earnings at risk limit. We are not breaching that limit. We are not breaching the EAR limit. We are not breaching the EAR limit. Now, in the question, is it covered in the institute study material? Yes. Is it possible for you to handle an exam? I don't think so. Not easy. Some part you could manage, but very, very difficult. Let us see what ICI did in the institute material. Gap exposure. A gap or mismatch arises from holding asset and liability and the off-balance sheet item with different principle. Positive gap indicates more interest rate sensitive asset, interest rate sensitive liability. Negative gap indicates more RSL. The gap is measured. Positive or negative gap multiplied by the interest rate change gives the earnings at risk. ER method facilitated to estimate how much of the earnings might be impacted. The changes in interest rate could be estimated on the basis of past trend forecasting. Bank should fix EAR, which could be based on last or current year's income, and a trigger point should adapt on. Gap calculation should be augmented by information. Now, people may say that if I practice more question, I can manage it. Maybe next exam they ask basis risk question, or they ask embedded option risk question, or they ask reinvestment risk question. You read everything, understand the depth of it. Practicing all type of questions is very difficult. IC could have been managed, but it is a theory from the non-core areas. Transaction exposure and translation. Transaction exposure is underlying exposure of any export or import. This is exchange rate on outstanding. If you have any debtor or creditor, this is a real loss for me. Translation is accounting exposure. This line is there in my theory material. And with this, we say transaction exposure is more critical because that is a real loss. Translation is just transferring the value from one book, that is translating the value from one book to the other book. It is just translation. It is a book based adjustment rather than real adjustment. Question 6a, 1 and 2 are general, 3 and 4 are very challenging. I'll read it. Aerotech Industries Limited, listed engineering major, evaluating the acquisition of Medgen Labs Private Limited, unlisted pharma laboratory. Data is given below. 6,000 CR, 450 CR merged. I'll have a merged column. Number of equity share, P multiple, market price or standalone fair value. Post merger PAT is 6850. 6,000 plus 450 is 6450. This is 6850. Difference of 400. Difference of 400 is basically the synergy gain at a PAT level. Synergy gain at a PAT level. At a valuation level, the synergy gain is 34,000 CR. All this I'll read in some time. First one and second one is manageable. Third, fourth is very difficult. What is first and second one? 6,000, 450 put together 6850. Extra 400 is part one answer. Extra 400 PAT basis. You divide by the number of equity share, get the EPS. P multiple is there for this. Valuation is 1,80,000. Combined entity they gave 34. Combined entity valuation from the combined entity. Value of merge firm is A plus M plus valuation gain. A plus M plus valuation gain. M is balancing figure 18,900. Reverse work 3780. Reverse work P multiple. So the P multiple comes through reverse working. P multiple 400 crores. Reverse working standalone P multiple of Medgen Labs, industry P multiple and fair value per share. This first and second can be managed. First and second can be managed. Difficult in exam stress. Third one they are saying, if you are going for three offers, one is cash. Cash means I pay 4,000. Second is I pay 1,000 plus Aerotech shares. I'm paying premium of 21.69% over standalone fair value. What is standalone fair value of Medgen? 3780. So I am paying 3780 plus 21.69%. I'm paying 21.69%, which is 4,600. In that 4,600, 1,000 is cash, 3,600 is shares. 3,600 divided by 360. My company price 10 shares I'll allot. 10 shares I'll allot. Rank all the three offer. If the price has touched 330, if the price has touched 330, cash remains 4,000. This will be 1,000 plus 10 into 330. 10 into 330. Bond, you have to do a valuation of a convertible bond. Valuation, they have not given any interest rate in the questions. I've assumed no coupon. I've assumed no coupon. I value the bond. Valuation of the bond is like this. No coupon. Fair value per bond and add that fair value and get the answer. Challenging. First part can be managed. Second part is difficult. Then came Black-Scholes model. I want to apologize to my students. In some way, I have messed up in my material also here. When I say I have messed up, what did I do for Black-Scholes model? It is covered. Everything is covered. Only thing is, I could have maybe tried covering it little bit more. What is little bit more here? See, Black-Scholes is covered in our material. Covered, generally not a preferred area. We have covered, we have said n of d1, n of d2, formula, everything is explained. What is n of d1? What is n of d2? I've not explained in depth here. At least n of d1 I've explained later. In that n of d1 is delta. Delta means hedge. Delta hedge ratio. But the question in exam asked for something like this. Current price is given, this is given, all this is given, e power, value of d1 is given. Hedge ratio, probability that the price on expiration will be higher. This is technically called n of d1. This is called n of d2. This I did not write in my material, but there in institute study material. there in institute study material. So when as we faculties try to simplify, sometimes miss out some points, which keeps happening. So all you want to prepare extra, your the only material which you should refer is institute study material. Word by word you have to read. You see the institute study material, they have clearly given what is n of d1, what is n of d2. We as faculties, or I as a faculty, blame for this. I have to take the blame for this part, because I did not write what is n of d2. I never thought that they'll end up testing what is n of d2. What is n of d2? I'll show you the institute material. Give me a minute. The above formula, probability that price on expiration would be higher than the exercise price, higher than the exercise price. So n of d1 and n of d2 is calculated. They have asked for 5375 is given. So this is 0.53, 0.54. Do interpolation between these two values, you'll get 5375. This interpolation part and all I have done. Interpolation part is there in my material, but what is not there is what is n of d1, what is n of d2. So blame I am taking is because I did not write. I somewhere, in order to save some space or some concept, short has happened there. I'll now obviously correct my material, but ICA may take something else in the next attempt. No, so so see here, we used to do all this interpolation. N of d1 interpolation, n of d2. All this we have taken from the Z table. All this I have explained in my material. What I did not explain is what is n of d1, what is n of d2. N of d1 at least explain. You do this, get this, get this. Then you do call valuation. Put is using PCPT. Put is using PCPT. Or this call and put, at least my student should be able to handle, because we have spent time on Black-Scholes. This part, what is n of d1, n of d2, the terms may be not clear to you, so that you could lose. Now, just to finalize the paper, this paper is difficult. There are no doubts in that. So paper is tough. Future paper may be tough. Don't go for difficult question, more preparation, AI drafted question. No, don't get into that strategy. No selective preparation. Theory can become a game changer. Paper will have certain easier questions, certain tougher question. Please don't follow anybody who says prepare for difficult question, prepare for difficult question, prepare. You can't prepare. One thing I am going to try and help you out is I'm going to try to give some MCQ kind of quiz in my Telegram group, where maybe I test the core concepts from the ICI study material, draft it in some form, and then give it to you. Maybe that helps. Not the standard MCQ question. I'm not going to get into it. Okay. Uh, this is my overall comment on the paper. I will say MCQ around 18-20 you can handle. Descriptive maybe around 35 marks you can handle, or 40 marks you can handle. 30 to 40 marks. Put together 50 to 60 marks. Handle possible. Balance some here, there, some here, there you can manage. And theory you should score marks. Theory you should score marks. So my advice remains same. Don't speak to people and confuse yourself. Follow whatever you have done, and please trust whoever faculty you have learnt from. Please trust him and continue with him. Don't change just like that. And also focus on institute study material in depth. In depth means you'll have to read it multiple times now, because anything can get tested. Don't try to do more question. Go to the depth of whatever is available as of now. Go to AI, type a para there and tell AI that can you give me some MCQ questions from this para which tests my conceptual understanding. Maybe that and all helps you. With this, I end the video. Any support, any assistance you need, please do send a message to me. Thank you, friends. You have been a warrior by attending this paper. Let us see ICI give some grace marks and we clear it. Thank you, guys.